You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music can mean but one thing. It is Education Wednesday. That means it is time once again to dive deep into the world of options with Options Playbook. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you're saying to yourself, wait, that's not the right guy for this show, you are correct. So allow me to introduce your usual host, Mr. Brian Overby, a.k.a. the options guy over there at Ally Invest. Mr. Overby, welcome back to the program for, dare I say it, our final huddle of the mad, insane year that was 2021, sir.
Yes, it is the final huddle for 2021, but it won't be the final huddle, period. We'll be back strong in 2022. But this is always a great time of year to get together and answer some listener questions. So we're going to take the time today to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, let's get down to it. You guys send in a lot of questions to this show. And also, if you're part of the secret club, then you guys can join us live today. A very rare live opportunity to put your questions to Mr. Overby. Usually he's live to tape. I have to drag him kicking and screaming into the live fires, but he has agreed to do so one final time for this year here. So if you're in there now, get your questions in. If you're saying, what the heck am I talking about? You want to participate in future live huddles and everything else we do here throughout the week, pro Q&A sessions, options oddities on Friday where we do some live trading as well as unusual activity and a whole bunch of other awesome stuff. Winners of our pro trading crates, everything else, theoptionsinsider.com/secret club. But be sure, don't tell anybody. It's a secret. Just between me and you. All right. They're already excited, Mr. O. They can't wait anymore. We got a question coming in from the live chat. This is a fun one to kick things off. Are you ready, Mr. O?
Yes, I am. Let's do it.
All right. This one comes from Nichols. He just wants to know, how did Mr. O, I like he calls you Mr. O as well, not just me. How did Mr. O become, quote, the options guy? He wants your origin story, sir.
Well, that's funny about the Mr. O, just in general. That's my father is a baseball and basketball coach, and he always had the cheer, hey, Coach O, let's open the door. And yeah, I won't complete that story. Oh, well, overall. But Coach O is always what my father was referred to when I was a kid playing basketball, and he was my head basketball coach in high school. One thing that I've always appreciated. But the options guy really came about from a blog. We wrote a blog at Trade King, and we needed to title it something. And this was back, Trade King now, we're talking 16, 17 years ago. So blogs were, I wouldn't say new, but they were definitely the what the cool kids were doing back then. So we needed a title for it, and we just kind of came up with the options guy overall. And so then when we made the playbook, it was easy to make the little leap because basically the blog was the foundation for the options playbook. Now I'm sad in that when Trade King got bought out by Ally Invest, or Ally in general, and became Ally Invest, that blog has gone away. We used to call it the Trader Network. We had a lot of good content in that overall. We now have one bigger blog called the Ally Community. But I don't blog as often in there, but I do a lot more content live because now what the cool kids are doing are podcasts and doing YouTube and all these good fun things as opposed to just doing blogs like we started way back in the day. So that's the origin story for the options guy, is that was the title of my blog overall when I was director of education for Trade King overall.
See, you're lucky, but you were ahead of the game with the podcasting thing too. So you can say you were one of the podcast cool kids before a lot of everybody else get hit. Now, you're not like me. You weren't doing it. This January, Brian, it'll be 15 years. Isn't that terrifying to say out loud?
Yeah, that's a long time.
That was literally the first ever options podcast. I get to wear that feather, but you were in there pretty early, sir. So you get a smaller feather, but a feather nonetheless for you over there.
Yeah, the community was something new that a lot of brokerage firms weren't doing. The compliance aspect of it kind of scared them away.
If I think back, what to me was one of these distinguishing characteristics of Trade King. Everyone has something, or every broker has something that distinguishes them. To me, it definitely was you guys were very early on that community front. And you're right, a lot of brokers are terrified by that. It's a compliance nightmare. But you guys were early on that. So a double feather in your cap. Speaking, you mentioned YouTube. Let's go out to YouTube for our next question. A lot of your folks like to listen on the old YouTubes. Hey, we don't judge. All of our shows go out there as well. It's kind of got a nice static image on it. You can quote unquote watch it on YouTube. Really, you're just listening to it, which is the way most people use YouTube a lot these days anyway, right? Hence YouTube music. It wouldn't exist if people weren't listening on the platform. But Scott Somer, he's a regular YouTuber listener. He comments on just about every video you make, Brian. He loves your stuff. He's always got some tweak or question. He's going back this time. He wants to know about episode 386, which was time for a ratio butterfly in Amazon. So think back to that one if you can. He wants to know, is there a reason why you wouldn't do your ratio fly 1x2x1, $40 wide on top side and $20 wide on the bottom side? So he wants to, I guess, do a ratio skip strike fly instead of a regular one. He wants to do it $40 on one side and $20 on the other. Brian, do you remember that episode enough to talk about it?
Well, yeah, but I know what he's referencing just in general. In general, the reason why we wouldn't go as wide is you're talking, as always, nothing's necessarily meant to be a recommendation. Whenever we're talking about these strategies overall, you got to look at the specifics of it. But if you go that wide, you're doubling the risk overall. So the big reason why was usually I try to come up with strategies that are, for lack of a better term, doable, affordable, I guess would be a little bit a better term in general. So if I'm looking at an Amazon trade, maybe in my own portfolio, I might go $40 wide, but usually on Options Playbook Radio, we're going to stay something fairly consistent, where we're just not going to add, we're going to do the lesser risk as opposed to more risk overall. So it's really all about your risk tolerance and what you're willing to take on. And that is true. Like in Amazon, it's very tempting to go wider because you can go so far out of the money on a skip strike butterfly around earnings. So you're like, well, there's no way the underlying stock could go that much, because it kind of lulls you to sleep because you go so far out of the money on a big stock like Amazon on a point basis, right? On a percentage basis, it's not insane. But on a point basis, you're going so far out of the money. So the whole reason is that I'm going to err to the side of less risk when we're teaching these strategies as opposed to more risk. But I do not mind doing that. And if you can go a little bit wider, that usually would mean that you're going to bring in a bigger credit overall. So you're going to do better if the underlying stock just stays where it's at or makes a smaller move in general than you would if you went to the $20 on the top side. Now, I do not recall the strikes that we were looking at, but I do understand the concept that Scott's asking about.
All right, let's keep the party rolling here. Let's go back to next up. We got Breaker. Maybe he's a truck driver. Breaker. He says, does Brian think this is a good environment to do a fig leaf in SPY? Does the premium level in the put make buying an in-the-money call less attractive right now? What about the tax consequences of selling out the underlying for the option at the end of the year? And lastly, I'm still confused about the margin treatment of this position since you're not covered by owning the stock. How does Ally treat this position as you get closer to the short strike? So Brian's got like a four-parter here on fig leaves. Luckily, he's talking about your favorite strategy. You can probably talk fig leaves all day. Fig leaves and skip strikes, probably 1 and 2 for you. But what do you have to say here for his multi-part question on fig leaves, sir?
Well, first of all, I'll start by just saying that now we actually have a name for the strategy. So you say fig leaf, and we know what we're talking about. So you got to go to the options playbook to see a definition of it overall. Suppose at this point in time, you could probably Google it and it'll come up. But what we're talking about is buying a deeper in the money option contract and then selling a short-term option contract against it. Now, on Options Playbook Radio, we just talked about one part of that last week, about buying a deeper in-the-money call option on a stock like Apple, which was a little top-heavy, which was holding up the marketplace overall, but we didn't do the second part of it. We didn't sell the call against that position. And, I like the concept of this. You are buying that underlying as a substitute for owning the stock outright. It gives you a little bit of a break if the underlying stock goes the wrong direction. And usually if I'm doing this, we're talking about looking at, you can pick the time frame. We're going normally 6 months to a year out in time. You're usually going a little bit longer out in time. But when we look at that trade, you kind of have your own stop points in it too. In that if you, I'm struggling with the frog in my throat, but if you're doing the fig leaf, what would happen is as the market goes up, and you get deeper in the money, you actually pick up delta. So you move more and more like the stock, but as the market goes down, you lose delta. And that's just a matter, that's just the way options are priced. And so a lot of times if I'm doing that and it comes down to the short strike, to the strike that I bought, that means it's an at the money option contract at that point in time, then that gives me an out. It gives me a sell. Now, we went through that in detail on the podcast, just about Apple in general. And it doesn't necessarily mean that it has to apply to just Apple. So it looks like from this question, taking the concept and applying it to the SPY. So if you do that, that's fine. This is an alternative to buying the SPY outright, which is the ETF that tracks the S&P 500 index. Now, if I do that, once again, I'm going to still use the same concepts where I'm going to be buying about an 80 delta or so. And I do not mind that as much right now. Now, today, the VIX is down below 20. I'd rather have a little bit lower VIX overall if I'm going to be doing this strategy. Around 20, I guess, is more of the normal nowadays. But I'd rather pay less volatility premium than more when I'm buying an option contract. So I don't mind this environment. When we were back around the 35% level, I would be a little bit. I would say no. I would probably lean against it. The SPY is a very liquid underlying. So if you do want to sell a shorter term call option against it, usually have decent bid-ask spreads. You can do that. Now, why do they treat this as a covered position? It's because you have the right to buy the stock at a lower price than you have the obligation to sell the stock at. So when you do this position, you are covered. You don't own the stock. And this leads right into the name of the strategy in the playbook. We always called it this because you're kind of covered. you have something that looks a lot like stock, but guess what? You really don't own stock, right? So that's where the fig leaf name came from, and actually came out of our trader network. We got that highlighted inside the options playbook. Under that strategy, there's a little blurb about where the name came from overall, but I think it's a real good name in that it really does sum up when you're doing this trade. One of the headaches of it is that if you are assigned on the short-term option, now what are you going to do? And inside the options playbook, we have a section about managing options, about how to roll a covered call position. But if it hits your short strike, you want an alert, you want to know that it happened, and you want to adjust the position or do something. Because if you're doing a fig leaf as opposed to a covered call, you're more than likely doing it with the intent of not getting the stock called away. You're trying to bring in some premium to help offset the fact that you still had to pay some time premium for that in-the-money option contract. So I err to the side of going a little bit further out, getting a little less premium, but that's okay because we're paying a lot less for the stock. You're usually looking at putting up anywhere from 15 to 20% of that stock price. Obviously depends on the expiration overall, but that's kind of where that 80 delta range comes in. So you're going to limit yourself to that. You're going to set an alert. If it does come down to your strike price, that's usually going to be your out point, because that's where the benefit of being an option actually helps out in this position. So I do not mind it. It is a way to use options to reduce your risk overall. Now the tax treatment, I guess this is a entire presentation, not just a question. You're going to have to, you do have tax issues, and it's definitely different if you're doing stuff like this in the SPY, which is owned by a stock, and it's going to be the same type of rules that if you close out that position in under a year's time, it's going to be considered a short-term capital gain. So I find this to be a more attractive strategy in a retirement account, where you don't have to worry about those concerns of getting in and out of it. And in most brokerage firms nowadays, you can do it. And in Ally Invest, you can buy in-the-money option contracts as a stock substitute if you got the approval level to do so in a retirement account, i.e. an IRA and a Roth. I guess that's going to be it for the show, huh, Mark?
That was an epic one. I like it. We got more people wanting to get at you here in the live. We got Options Queen. She says, how does Brian decide to do a regular fly versus a skip strike fly? And while you were talking, someone else, Mr. Unlimited, chimed in and already answered it for her. He says, it's always a skip strike fly for Brian. And he laughed out loud. So he answered it for you, Brian. Always a skip strike fly. But in all seriousness, how do you choose between the two, sir?
A lot of it is about the amount of premium that I can get versus the risk. So if I am doing a skip strike, it's going to be underlying specific, and where I got to weigh the benefits, because if I do add on or I do skip the strike of a standard butterfly, that's why I like the name skip strike better than modified, which a lot of the pundits like to use. I would prefer to say skip strike because that's literally what you're doing. You're embedding a short call spread inside the butterfly to pay for that butterfly. So ultimately, the reason why I would do that is that I can get the butterfly done for a decent net credit to the account. So that is the main reason why I'm going to do it. Now, if I look at it and I skip that strike and I just, I'm doing it for a nickel, a dime, maybe 15 cents, I'm like, why do I want to add that additional risk to the position and get a small credit for doing it? So with all that being said, that means that it's usually based off of what's going on with the skew, to get a little bit technical with it. So on underlines that have a little bit more volatility, and we talk about skips around earnings and stuff like that, they usually are a little bit more attractive than when you're doing them not around earnings overall, or in lower implied volatility environments. There's many different ways to say that. So you usually need some volatility, and you want some predictability. It's a little bit of an oxymoron when you're looking at doing a skip strike overall, but it's really all about, I'm going to add risk to the trade. Is the net credit that I'm going to get done on the butterfly worth it or not to me?
All right, there you go. Options Queen. We got more here. Frank 1209. He says, does Brian think we're past the Omicron volatility, or will we see another flare-up before the end of the year? And also, are there any particular trades or trends that he's keeping an eye on for the new year? It's another two-part. Getting multi-parts thrown at you here, Brian, left and right. First off, Omicron, yay or nay, is it behind us, or are you expecting maybe a little more? And then B, what are you keeping an eye on for the new year, sir?
All right. Well, I'll leave the Omicron to Dr. Fauci, but I will tell you this, that I did see a study this week that the marketplace has kind of moved on from the Omicron variant in that when asked of retail clients, and I'm paraphrasing, I wish I could be a little bit more exact, what is driving you in the marketplace? About 3 months ago, everything was all about the COVID variants. And nowadays they're talking about inflation. So the mindset of the marketplace, just as far as retail clients are concerned, has changed to be more concerned about the inflation and less concerned about the variance. And I kind of think of it this way, and I obviously do not know, but I think more people are comfortable with the fact that we are dealing with it, and that they won't necessarily shut down the economy because of an outbreak that's caused by the variant. And I like to put a little twist in it. That would be my little twist as to why people might be more worried about inflation nowadays than the different variants. But I don't know exactly. I am still concerned about it overall. And we're still not fully vaccinated, and it's still hurting supply chains, especially in third world countries and just across the globe overall. And that does still affect the marketplace, and it could be a reason why we drive up some inflation.
Speaking of inflation and the Fed, who were all the rage today, we've got Aveo here. He says, can Brian do an overview of the impact of rates on the prices of calls and puts for all of your listeners who are watching the Fed this week? Well, obviously, Brian, we got our Fed answer later in the session today. Vol got clobbered a little bit as a result, but Aveo, and I'm sure some others out there want maybe a bit of a refresher on rates and options price. You know, everyone's favorite row. We talk about it all the time, right, Brian? Everyone's top Greek.
Yeah, I think in the playbook we make a joke that Roe went out to get a gyro. And that because we just don't go into much detail. We'll define it, but we're not going to go into as much detail. But Aveo is right to bring that up, and specifically with the way that the questions are going today. What Roe does affect more than anything are long-term option contracts. More specifically, more at-the-money contract, things that have more time premium in them, because it's all about carry cost. And you can say it's interest rates, but it really just comes down to carry costs. So if interest rates increase in price, then that adds carry cost to a position. And so when I increase that rate overall, calls will become more expensive and puts will become cheaper. You might not notice it on a short-term option contract, but if you're buying 1 year, 9 months to a year option contracts, it does have an effect. Now, you need a pretty decent sized move for it to have a real effect overall, but the cost of carry is part of every option pricing model. And when that number changes, it could be the stock decides to pay a dividend or doesn't pay as much of a dividend, or interest rates increase. That component is accounted for up front in the price of the option contract overall. So what does Roe affect more than anything? It affects longer term option contracts. It affects if interest rates increase, it affects calls positively, if you will, independent of the movement of the underlying stock, and puts negatively independent of the movement of the underlying stock.
All right, let's see. We're coming up against it, so we'll get you out of here on this one. Kind of a fun one here from NJLT. Basic, but still fun. They want to know, how do you decide when to use a spread versus an outright option, Brian?
Well, it's a little bit about volatility. So I'm looking at it, and if I'm concerned about a volatility decrease, I would look at a spread. Also, it's the price of the underlying. because if I'm looking at trading, well, today we talked about Amazon versus Apple. I would be more apt to do a spread if I was, let's say bearish, just because we've been bullish forever. So let's say I was going to do a bear put spread in Amazon versus a bear put spread in Apple. I would be more apt to do the spread in Amazon than I would in Apple. And then, and it's mainly because of the overall cost of the option contracts. If I'm looking just in a vacuum on a $1 basis or on a one contract basis. So the higher the underlying, the more expensive the option contracts are going to be. And also the higher the implied volatility, the more expensive the options are going to be to purchase. And so with that said, we talked about the underlying price. And then one time where if you're really speculating on a movement of the underlying stock is usually around earnings. So very rarely would I speculate on earnings without doing some type of a spread. We mentioned skip strike butterflies or butterflies overall. But if I was considering buying a long call or buying a long put to speculate on what the earnings were going to be, most of the time I would be doing spreads in that scenario as opposed to just buying the option contract outright.
All right, Mr. O, glad we can get you here for a fun live huddle. Glad to see so many of you were able to get in there and ask questions. Of course, if you can't listen live, we get it. Or if you're not part of the secret club, you can always get in the old-fashioned way, questions at theoptionsinsider.com. Social media, all the other ways to go. You can also send them over there to Mr. Brian directly. He's pretty active over there on the old Twitters these days. Mr. Brian, if they want to reach out to you directly in between episodes, they have a question or a comment for you, where should they go? What should they do, sir?
Well, I actually have a few new things to say this time around. You can always follow me on Twitter. I try to tweet about all the educational events that we do. And my handle is very simple. It's at Brian Overby, my name. And then lastly, we actually set up a landing page to sign up for an email list for everything that we do. ally.com/investeducation. All one word, invest education. So ally.com/investeducation. You can sign up and we'll email you usually about once a week. We don't just pilfer you with emails overall, but usually about once a week or so we'll say, this is what we're doing this week in the education front. So please check that out. And as always, this is it for this episode of Options Playbook Radio. May all the options that you buy finish in the money and all the ones you sell finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.